All right, looks like our investor participants are getting comfortable, so let me welcome you officially to Investing in Main Street. This is our discussion of supporting American. I'm Eric Cantor. I'm the CEO and co-founder of Vincent here in New York City. You can see my background. You can also hear some of the authentic Holland Tunnel noises that are actually being piped in as we speak. We're a marketplace for alternative investments. We're focused on individual investors taking through the journey of building an awesome portfolio. We help people research, diligence, and invest in great non-traditional opportunities across venture, real estate, debt, art, collectibles, and crypto. So come check us out at www.withvincent.com after this to learn more. Our guests, our panelists today are three awesome investment platforms we work with. They're all on the front lines of enabling investment into small businesses in the United States, which is what we'd like to talk about. So let's go ahead and dive in. We're going to talk about opportunities. We're going to talk about challenges, and we're going to let the audience here ask questions as we go. So please use the Q&A tab on your Zoom to engage with our panelists here. Before we start, let's do one quick disclosure to keep everybody informed. Nothing in this presentation should be construed as an offer to sell securities or a solicitation of an offer to buy securities. All investments involve risk and the possibility of loss, including loss of principal, and neither past performance nor forward-looking information is a guarantee of future results. We all know that, so let's get started. There's a lot to cover. Game plan for the next 50 minutes. We're going to dig in with our panelists, periodically look at our chat, and just try to drive the conversation along. Starting point, a few facts and figures about the economy. We are talking about small business, and so it's worth keeping in mind, just how big this sector is and how much of the activity in our economy it accounts for as we go. Let's start with a quick overview on our three investment platforms. Nick, what is your platform and what are your offerings like for individual investors who want to blend their profit and impact motives here?
For sure. So firstly, thanks again for having us here. CEO and co-founder of Mainvest. So we're a Reg CF investment platform, meaning available for both accredited and non-accredited investors, retail investors. I prefer over non-accredited, which is a mean term. And it's basically a marketplace enabling investment directly into brick and mortar small businesses across the United States. We've got around 450 offerings listed on the platform over the course of the last year or so, really focusing on like core cash flow focused businesses, a lot of food and bev, a lot of retail, a lot of breweries and bakeries that are using this as a means of capital formation that kind of ties into getting capital from their greater community and going at like running those campaigns, getting that social and market validation, and then opening it up to that point for retail investors that are exploring it as part of that social underwriting process. And the securities are structured as passive income revenue shares with returns provided quarterly based on the revenue generated by the business.
Awesome. JD, you want to tell us about Supervest?
Sure, Supervest, and thanks, Eric, and Kenny and Nick, great to be with you guys on the call today. What Supervest is, it's what I think is probably the first, if not only, marketplace platform allowing accredited investors. We don't currently allow non-accredited investors, so just accredited investors access to the merchant cash advance asset class. Merchant cash advance is a unique form of financing that businesses use that traditionally for businesses or merchants that can't get traditional financing either through banks or their credit cards or et cetera. It's been a historically extremely hard asset class to access for any individual investor, and Supervest has created the platform that allows these accredited investors to fractionally participate in these underlying deals. We've done, since inception in late 2018, we've done over 15,000 merchant cash advance deals our investors have participated in. In excess of $50 million have been participated by investors, and the available deal flow on the platform through that period is over 300 million to date. So one of the unique things, just to highlight in a merchant cash advance deal relative to maybe what Kenny's doing and what Nick is doing, these deals pay back traditionally on a daily basis to the end investors. So the investors seeing remittances coming back each and every day for the most part, relative to your normal fixed income investments that might see those quarterly cash flows or even yearly cash flows.
Kenny?
Love it. So my name's Kenny Rose. I'm the founder and CEO of Franshares. And Franshares allows you to invest in the franchise industry. You get access to a whole portfolio of franchises diversified by region and geography and industry. And you get access to both the equity and the cash flow that they produce. We're actually launching next month, and you can actually see the current wait list behind me. So make sure you hop in and join that. And you might see it sputtering in the background, so don't mind me.
I think it just went up a couple. I see. So tell us about, so we've got a few facts and figures here about the U.S. economy. Maybe just with an eye towards this, and let's start with Kenny, who went last there. Tell us, in your view, where is the economy at, and really focusing on the parts of it, of the American economy that you're most closely interfacing with.
Yeah, well, I'd say we're still in the recovery phase, but at the same time, there's a lot of growth happening just from everything that got shooken up during the pandemic and especially quarantine. Coming from the franchise side of things, you've seen different areas affected very differently. Ones that required more of the retail storefront. You saw people having closures for months, and whether or not they had access to additional capital was definitely a worry there. And then you have some more of the more pandemic resistance ones. So service industries and like waste management, even automotive did fine, and some even thrived, especially in the food industry. So it's like a lot of American things. You see a lot rising fast and a lot falling fast. So it's been a really divisive split.
Are there certain franchises that either significantly outperformed or significantly underperformed in this recent environment, say the last 18 months?
Oh, I mean, there's a ton of them that on both ends, just because the industry's so wide. There's over 4,000 different franchise brands out there, which is more stocks than there are on the stock market. So you've had ones, especially in like home services, that have done very well. Everything from like whether it's maid services wanting to keep clean, but also things like even home insulation's a thing that's franchised and people are working from home more. So you have to have reduce your heating and cooling costs. You have to insulate so there's not as much outside noise. And so you'd see a lot of different areas that are really expanding. And again, some of the things like hair care and fitness that took took a big hit initially, but now are really coming back strong because people are just trying to get out there.
JD, what's your take on what's going on out there?
Yeah, I echo a fair amount of what was just said. I mean, I think it's definitely strong. I think really the question is for us here today, and even for most investors out there, is what's the picture going to go forward, right? I mean, I think the government and what they did with supplying the vast amount of dollars into the system, whether it's through PPP or the Fed through their monetary stimulus actions, they really did help out the economy. We see it, across our merchants, thousands of merchant deals that we see, specifically what we've seen. And I think this echoes what was just said, traditionally, what might've been tougher credits for us, kind of trucking and logistic businesses, they've done exceedingly well coming out of the pandemic because of the supply chain issues. What got hit probably the most hardest in the pandemic were, again, reference the restaurant business. But coming out of the pandemic now, some of the best credits we've seen are back in the restaurant business, because if you're a restaurant, you survived through the pandemic, and whether it's through takeout or you just had such a standalone business, you're able to get through those 3, 4, 5 months, whatever it took, and you came out the other side of it. It's a great business to be investing in. So I think the question now is going forward, what are these merchants, what they're worried about? And, Eric, you put up some data there just now. Some of the data I looked at just last week, some of the concerns for these merchants. And when I say merchants, I mean the small businesses you just referenced. It's inflation, it's supply chain issues, it's basically hiring, and it's continuation of COVID and the variants that come with it. And the biggest things that worry those businesses are working capital. And I think everybody on this panel here today, that's kind of what we're doing, trying to supply these end businesses and merchants with continued working capital. As the government assistance wanes off, whether it's PPP or the Fed stimulus, I don't know what's really in the the BBB that's coming up, whether that gets passed in the House and the Senate. I don't know how much is in there for the small businessmen that there was in the PPP. So I think there's some concerns going forward. And I think that's what we're all here today to do, is, make sure these small merchants, small businesses have continued access to working capital to keep pushing forward.
Talking about some of the changes on the merchant side, what about on your side? Have you had to change anything about the business dramatically, or?
Yeah, no, well, dramatically, no, but underwriting, yes. And kind of what I just referenced before is, traditionally looking at, logistics or trucking companies, they maybe have not been the best credit for a bunch of different reasons. I won't dive into deep here. But again, coming out of the pandemic, what occurred with those trucking logistic companies because of the supply chain issues, what did they get? They got pricing power. Demand was taken out of the system. And all of a sudden, these trucking companies, whether it was a small mom and pop truck company with 2 or 3 trucks, or one with hundreds of trucks out there, all of a sudden they saw demand go up, pricing power increase. They needed a cash advance quickly for, to buy 1 truck or 20 trucks. All of a sudden they became a much better credit in the eyes of our underwriters relative to the restaurant business. And our underwriters prior to COVID, restaurants were 10, 15% of any given merchant cash advance portfolio. They were very good, very stable. You could look at what their last month historic receipts were and get a very good idea what their cash flows are going to be. All of a sudden, the pandemic threw that kind of underwriting concept out of whack. And restaurants now tend to be a little dicier because you don't know what's going to happen with the next variant and that may come down the road. So what's occurred there? Pricing has gone up in terms of underwriting potentially a restaurant deal relative to where a trucking company may be today.
Nick, what are you seeing out there?
So it's interesting when you talk about the underwriting, and I think, when you look at just the brick and mortar impact of the pandemic with like retail, food and bev, restaurants very specifically, you are looking at, closure rates 30 to 40%, depending on, which stat you're pulling over that like 12 to 18 month period. But you're also looking at the subset of them that were incredibly resilient, were able to make it through. And I think that was one of the most exciting things, like seeing live across the asset class during the pandemic was, breweries expanding to outdoor tap rooms and being able to expand takeout, retail that was resilient, launching e-commerce, even like yoga studios launching like online services as a means of surviving. And then coming out the other end of that, as things are starting to recover and get back to normal, suddenly there are incremental revenue streams from this change in behavior that previously weren't accessible or weren't like core market opportunities in the eyes of a lot of small business owners. Interestingly, the way kind of like the underwriting marketplace model works for like our subset of the asset class is fundamentally driven by the social and community underwriting. So these businesses are going out, raising capital directly from the community first and unlocking a threshold of market underwriting that then enables, that the asset to be, brought onto the main invest platform publicly for retail investors to evaluate. And for us, COVID was kind of a real pressure test of this thesis where you're looking at the institutional underwriting models. For one, they're just not well equipped to underwrite new businesses. And that's why if you look at a lot of SMB lending, you're looking at 1 to 2 years of revenue history, immense amount of personal collateralization and equity. And so putting that in the hands of the community throughout COVID was really the most impressive pressure test of that thesis. We saw 2 business closures across the entirety of our subset of the asset class, out of 450 plus in that 18-month period. And one was like an escape room, which in terms of, it's really, really tough. I saw a lot of escape rooms that did actually successfully bring that digitally, which was a cool kind of like sub-trend in that industry. But that kind of pivoting to where we're at right now, you do still have on the aggregate 30 to 40% business closures accelerated through the pandemic. And I think one of the stats that you call out there and looking at the increase in new business formations, the last 3 quarters were around like 1.7, 1.8x the average quarterly new small business formations in the US for the past decade. And so with that loss, there are a bunch of new entrants coming into the market in need of capital, willing to provide yield to investors to capitalize against an institutional lending market that's ill-equipped to underwrite these new businesses at this point in time.
So just translating that into how you've had to adapt, what did you need to change from what you were doing?
I think for us, like at the height of the pandemic, there's an inflection point around because there's the community aspect to it. There are businesses like I guess in our pre-underwriting process and vetting process, businesses that like a lot of businesses were coming to the platform, like trying to raise stay alive money. And I think at that point we had to make a really just like hard and strong kind of call that like that wasn't like, the core future of the platform. Like there are donation-based crowdfunding aspects that can be well utilized and well equipped for like that type of community support. But really like focusing on, businesses that were attempting to grow through the pandemic, that were attempting to pivot and adapt business models and had viable paths forward, was like challenging with a bunch, just like the volume of inbound businesses looking to utilize the service in need of capital grew exponentially.
Mhm.
You all kind of mentioned government action, and obviously that's been a huge influence on a lot of things happening in the market. So let's dive in there a little bit, both on the demand side and on the regulation side. You mentioned some of you are serving accredited investors, some are serving a mix. Tell us about the kind of state, the impact, let's say, of government action on your business currently, and what you'd like to see developing there in terms of trends. Why don't we start with Nick again?
For sure. I think the most recent March of 2021, there was an overhaul and continued deregulation in the regulation crowdfunding space that like increased the maximums, created like the maximum amount that a business could secure through the exemption, simplified the definitions of like different tiers of investing to make it easier for retail investors to like understand the risk and deployment of their capital into the space. And that was incredibly beneficial as a means of growth and coming out of this and being able to open that up to businesses in need of larger amounts of capital with different like use cases and everything. I think all of us can't go on about the last 18 months without talking about the PPP and that massive influx of effectively non-recourse lending into the small business space, which did result in many businesses being able to navigate through that, which they otherwise wouldn't. I think we all talk about in our theses the challenge of access to capital for small businesses being an acute challenge. And it's interesting to juxtapose that with the last 2 years being like the two largest years of federal lending into the small business space in the past 10 years. And I think there's an irony there around how that's structured, and that's not going to continue at the rate it is. And so as that kind of crutch that was needed to keep our like domestic economy afloat during this crucial time starts to wane, a lot of those pre-challenges that businesses have been facing for 10, 15 plus years, basically since the drop in lending after the 2008 recession, that they're going to come back, and businesses are going to be needed to be exploring different and new viable options for capital formation. And that's where retail and accredited investors being able to participate in that and drive capital into our domestic economy. There's not just a yield opportunity there, but there's the opportunity to further accelerate both our rebound as well as like long-term economic development on a domestic level.
Yeah. Reg CF changes were big that you mentioned, March of 2021. I don't think that's been fully digested yet. People aren't making, as much use of that as you would have thought. Those also were not responding to the pandemic. Those were long.
No, those were long commented on.
But those are definitely going to have an effect over time. So Kenny, maybe flip the question to you. How is government action, whether it's regulatory or money supply or otherwise, what do you see the impact of your business either on either side of the marketplace?
Yeah, so I think this is another one that was a bit of a long time in the making, but the Department of Labor actually came out with a very interesting stance. In the past, traditionally, you couldn't have alternative investments in a standard company 401k. And so the Department of Labor came out and they started seeing, especially during the pandemic, that people were really flooding money into alternatives between like access and new forms of it. And so the Department of Labor issued their statement saying that, hey, we're actually going to start letting people use their 401ks towards alternatives. And so I think this is something that you'll start seeing like larger and larger companies open up for their employees. And so you'll start seeing, based in Chicago, United Airlines will start letting their employees invest into artwork or retail or franchises. So I think you'll start seeing alternative investing between that and the changes to Reg CF, like really changing in the next 5 or 10 years.
Yeah.
JD?
Yeah, I would just, pick up with what Kenny just said, and we've seen it here on our platform. For example, we're starting to see, we haven't seen as many kind of the corporate plans come on yet, as Kenny referenced, but the ease now of moving maybe your IRA or your 401k capital out of your traditional, I don't want to name names here, but your traditional sponsors, who are the big guys out there, into these alternative IRA providers. We've seen an influx of investor capital coming through that, who the accredited investors that we deal with are much more comfortable dealing with or sourcing alternative investments, such as ourselves, such as what Nick and Kenny are doing on their side. I think that's a trend that certainly continues, if doesn't accelerate much faster than it has been. And then I would just touch on the other side of the coin when you were talking about regulation, from kind of an underwriting or merchant side of it, Eric. What we're seeing here from our underlying merchants that our funders are underwriting, and then we're kind of underwriting them forward. There's what they did with PPP was terrific, but there's now such a kind of all over the place regulatory environment, from state to, not just state to state, but town to town, whether it's, COVID vaccines, whether it's mask mandates, whatever, whether you're for or against it. I don't have a dog in the fight, but we're actually seeing, we see different businesses just one town over, because of certain regulatory environments, see a different flow in their sales based on a certain regulatory regime. That's one thing, our merchants, I mean, we are downscale. We're talking with some very small merchants here, but it's impacting these small businesses out there. It's something to keep an eye on.
So you mentioned the retirement account development. So let's just double click on that, because
Sure.
it's important to all the investors in our audience. Speaking to me as a potential Supervest investor, like, what factors should I consider in whether I deploy through my normal taxable accounts or my IRA or some combination? What are the upsides of?
Yeah,
using a
the biggest thing
retirement
for us is because, one of the interesting things about MCA, I think I referenced it in my opening remarks, is the way an MCA works is you fractionally participate in a merchant cash advance. And the way a merchant cash advance deal works is you advance the merchant, say $10,000. You're purchasing technically their future receivables, so it's not a loan, so you can charge higher than traditional interest rates state by state, so you avoid usury loss. So the traditional payback on a $10,000 advance to a merchant might be $14,000. They pay that back, the merchant, over 6 months. So you can see that's a pretty high interest rate. It gets even more attractive because that typical merchant is paying you back every single day. Consequently, from a tax perspective, those are short-term gains effectively, unless you have some master accountant. Because they're short-term gains, the natural place to put this kind of product is in a tax-deferred structure, whether it's an IRA, 401k, a trust, however you can get it into, makes all the sense in the world, specific to the MCA, given its short-term nature.
Got it. Would either of you like to add anything on the retirement account side? Whether that's a big piece of your business, Nick?
I mean, it's definitely something that, as a trend, we're excited about. As I think Alto IRA being an example of one of the early leaders in developing these like checkbook IRA, self-directed IRA accounts that utilizing technology to enable more like direct investor control of their funds and ability to diversify those funds in a larger swath of alternative investments is super exciting. I agree that, like, with the acuteness of a merchant cash advance, like, it's exponentially beneficial to like some things that have like longer term returns, and especially if like you're looking at how principal and interest are structured. If that interest, like those interest returns are back weighted, it's still beneficial, but not to the same exponential degree. So we're really excited about it. We have our tech team working on multiple implementations to continue to build that out and create that option, like we call it, like just investment channel optionality for our investor base. It's a big part of our 2022 roadmap.
By the way, I did just see your list tick up, which was exciting.
That's fun.
Let us know about 401ks and IRAs.
Yeah. So honestly, it's been really interesting because I feel like they got ahead of like that regulation I just mentioned that the Department of Labor loosened up, because they got ahead of the curve and they said, hey, people want alternative investments because these things like Reg CF came about that it wasn't being facilitated in the traditional ways. And so when you're not facilitating in traditional, someone new is going to come up and be able to offer that for you. So it's really nice seeing all these guys come up with all that, and especially with the tax advantages, like John mentioned. So we're seeing the same thing because there's dividends paid out so often that it's really helpful to have that in that type of account if you are working with those type of assets in general.
Gotcha. So let's shift away from some of the external dynamics impacting your markets to the investors themselves. So I'm an investor. I want to support this country, get involved in the recovery. My profits are not just profit. My purpose is not just profit. I want to have an impact. So what is the real impact of this type of investing, and how should I, as an impact investor, if I can call myself that, go about targeting, measuring, and tracking, impact? Why don't we start with Kenny?
Yeah, so I'd say one of the biggest things is job creation. We've been seeing a lot of people who are slow to return to work because they don't have consistency. And I think when you have, capital coming from the greater crowd that can make these businesses properly capitalized, pay employees properly, as well as like keep them fully staffed. That's a really big thing to keep going here. And especially when you mention like the number of establishments, investors are looking to grow more local small businesses and kind of keep up this circular economy where, where you're going shopping is a part of your community. You want to keep dollars in your community that are paying taxes in your community and help grow, whether it's new schools, new infrastructure for the long term.
Cool. Nick, what's your take on impact and how, as a main vest investor, I should think about it, target it, track it?
Well, I think different alternative investors define impact in different ways and have different kind of goals and thesis points for it. For example, we have many investors on the platform that are very excited in investing in Black and minority-owned businesses or women-owned businesses and being able to invest directly into those entrepreneurs and kind of reframe the challenges that they face around institutional capital access and the capital gap there, being able to directly do that. And then there's the economic impact side of things where, to that point of like circular economy, is when you're able to take previously inaccessible capital in a community and directly infuse that into like market underwritten businesses in that community. Those businesses, they need that capital and they can put it to work. And the way they put it to work is through job creation, is through growing the business, paying back, paying taxes locally, driving that forward. And where that really ties out in terms of not just like the circular loop, it's like not just through spending money at those places, but by investing in them, getting those returns and then reinvesting those returns. That's what like creates kind of a closed loop capital growth cycle that was really not possible, before some of these regulatory changes, at least on such like a hyper targeted, like business to business method.
JD?
Oh, sorry, I couldn't hear you. I would, I think Nick, he hit it, right on target from where we stand. And I go back to some of the data you put up in the beginning of the slide, Eric. I think 90% or 90, I think it's closer to 98% of the actual unit businesses across the country are small businesses, right? And I think one of the numbers you had up at the price, I think 50% of the country's workforce, I think you had on that diagram, are employed by small businesses. And I think that loop that Nick was describing, that's what our investors think about. It's their ability to take the place of the small bank, the community bank that used to service these small merchants out there. That's no longer there. It simply just isn't there. These small community banks, never mind the regional banks, of course, the commercial banks, they really just want to write loans on large real estate transaction because each loan costs about the same. They don't want to write a loan to the $10,000 merchant who needs a new pizza oven or the auto body guy that needs a new lift, because it broke down and he's waiting for his insurance check to hit. I think many of our investors, sure, they love the returns. I mean, that's probably first and foremost for most anybody. But I think what they love is they're exposed to a typical investor on our platform is exposed to over 500 to 600 individual deals themselves. helping anybody from a nail salon to the aforementioned auto body guy to the trucking company with 2 trucks up to the 100 trucks that I mentioned earlier. So, I think what people understand is, and this is another data point, but 80% of these small businesses fail, because of working capital needs. And, the banks aren't there for them. As sad as that is to say, it's not the It's a Wonderful Life with the Bailey savings and loan. That's gone. I think we are, the guys we're talking to right here, we're now the George Baileys. We're allowing accredited investors or unaccredited investors, retail investors, to be that source of working capital for our community. I think people take away a lot from that.
What a well-timed reference.
Exactly. Nick, have you looked, just out of curiosity, at this theme of like, I want to support my local community? So maybe the question is, do investments have any correlation to where someone's coming from and where they're investing? Or is that a kind of one of those myths of early crowdfunding?
No, it's absolutely not a myth for us. I think it is definitely going down as like more and more reinvestors are like coming into the platform and are investing, across the US. And when you talk about local and community, I think the community concept, there are different communities that aren't necessarily geographic, but, with how we work, really the core model is businesses are going out and first directly going to their community and securing a portion of the capital needed. And by getting that community and social underwriting, market validation, people in that community voting with their wallets, and then being financially incentivized long-term for that business to succeed, being able to, on the back end, not just provide working capital, but working capital that actually works with the businesses as consumers, as evangelists. That cycle has really continued to be prevalent and is the core underwriting aspect of, I think, what's driven such high performance in our subset of the asset class to date against the mean, if you look at, especially against this pandemic.
So staying focused on our investors and their needs. And by the way, anybody on the webinar right now, feel free to drop a question in the Q&A and we will address it with the panel. So let's talk about diligence, right? So you've won me over. I really want to invest in Main Street, create some impact. I'm showing up at Supervest. I'm showing up at Mainvest. I'm showing up on FranShares. I got some money in my bank account, but I also have a day job. What kind of diligence should I be doing? I mean, how do I get myself over the curve of seeing a bunch of deals, seeing a bunch of terms thrown around that may not be what I'm using in my day-to-day, and be able to make a high conviction decision? Yeah, I want to invest in this franchise or this loan, or however you bucket it. Maybe we start with Kenny on this one.
Yeah. So I'd say you start from the top down, like get a good understanding of like the asset class as a whole before you start looking at specific deals. We're really big on like franchise education and making sure people understand the industry, how they work, before they ever start looking at a specific deal. And then, we encourage everyone to really do as much due diligence as possible. Like that's why we register with the SEC, and franchise, it's regulated by the Federal Trade Commission too. So, we're trying to get all these levels of transparency there so investors can make a wise decision. But at the same time, it's only as good as your ability to go through and look at it. Like if it's not worth your time to look at the details, it's, going to really bite you back in the long term. So we definitely encourage people like understand the general concept, then understand the details of the deal, and then get down the nitty gritty. So, people have day jobs, but they also have time at night to go and do some investing or do some research. It's just a lot more important to do that than to skip the small print and find out later what you missed.
Got it. JD, how should I go about my diligence?
Yeah, sure. For Supervest, I think we might have a slightly different model than what Nick and Kenny are doing. So we actually think, given the amount of deal flow I've referenced before, tens of thousands of deals flow through our platform on a yearly basis, and their fractional participation. So an investor could be anywhere from $50 up to $5,000 a deal if they would decide to do so. So we think it's extremely difficult for any individual to to do due diligence on, as I mentioned, your local pizza shop, your local auto body shop. That's going to be really hard to do, and they're not built to do it. The cost benefit isn't there. So we've taken the approach at Supervest is we actually go out and partner with merchant cash advance funders or underwriters themselves. We effectively underwrite the underwriters. So we have 21 funders that roll up deal flow onto our platform. We take that underwriting responsibility of these funders themselves. We do it for our investors. So they go through a deep dive due diligence process. It takes probably 2 to 3 months, just like we're underwriting an institutional credit line for these funders that they're going to access a line of capital. We perform that diligence. Once a funder passes through our due diligence, we have a continuing ongoing due diligence, performance, governance, et cetera. But we feel, given the cadence in the amount of deal flow that rolls up, we kind of do the diligence of the deal flow for our end investors. What we ask our investors to do is set up kind of a risk profile about the kind of deal flow they want to participate in. And they can, on a bespoke basis, create that profile, the type of merchants, the type of industry, the type of FICO scores, how long a deal term they want to be participating in. And we have a matching engine, not unlike an exchange, where as a deal rolls up from our funder partners that we've underwritten, and it matches to the profile of the accredited investor, a match will occur just like you're on a stock exchange, and that deal will be funded on a partial or a full participation level. That's how we think about the underwriting part of it.
That's cool. Nick, same question for you. What diligence should I do after showing up on MainVest and looking at all the awesome deals that I might be able to get involved with?
For sure. I feel like I have to tread carefully on this one as the lone FINRA regulated crowdfunding intermediary around providing investment advice.
It is being recorded.
Right. And I want to be respectful of that. But really how underwriting works on the MainVest platform, it starts with a MainVest vetting process that is incremental to the regulatory diligence process that is part of regulation crowdfunding in terms of, collecting 2 years of historical financials, running SEC bad actor checks on all beneficiaries, looking for past liens on finance, and all that kind of the technical stuff. For any investment that you see listed on the page, beyond that, that business has already gone out and secured a certain amount of that capital from that community market underwriting. So first there's the MainVest vetting. And again, we're not the lender, we're a marketplace as well. So we're not lending to these businesses. We can't really call it underwriting them, but quotation mark vetting of the businesses and their viability. And that's looking at pro forma financials, historical financials, category of business. As an example, if a natural grocery store is looking to raise on the platform and we see a profit margin of 25%, when we know the national average for national grocery store profit margin rates are thin around 4.5%, that would be a flag, and that business wouldn't be brought onto the platform. But beyond that, then you get into the community vetting and the community underwriting aspect of it. And then once it's solicited out to investors through the platform, then there's still the general market underwriting of that business needing to hit that target amount of capital that they're looking to raise based on their needs. And if a business is unable to secure that amount of capital, the money gets all returned to investors and the deal doesn't go through.
Let's shift gears again to the industry insights, and then maybe flip back to the investors to close this out. We're all in the technology business, right? All of these platforms and things we're building are involved in, enabled in some way by tech. Would be interesting to get your view on how technology will continue to impact the business you're in, the space. I'll note that this is the first call I've been on in probably a week where no one said the word Web3 39 minutes into a call. Not sure what I should take away from that, but where is it headed on the tech side specifically, and how is that going to enable or challenge or create opportunity for this whole investor base? Why don't we start with JD on this one? Sure.
I would say, tied back into, the prior conversation, probably the biggest thing we're seeing, Eric, is on the underwriting side. I could speak to the technology and the platform and whatnot from the investor facing side. There's always going to be upgrades, the UI, et cetera. But specifically to improve, both investor returns and then eventually get the cost of capital potentially down to the end merchants. What we're seeing on the underwriting side, and I hate to use it, you mentioned a buzzword, Web 3.0 or whatever, but it's a little older, but the buzzwords with AI, machine learning, neural networks, they're real. We use them, and they're helpful. We use them on our underwriting. We use them to help underwrite our underwriters. We use them as a net over our platform as deal flow comes up to us. And it serves two purposes. One, it helps, if we see using kind of our AI that we've incorporated into our funder deal flow to make us smarter about what we allow onto the platform, that helps our investor returns. But there's a big part of it for our funding partners using those technologies, which a lot of these MCA funders have not used, haven't been able to afford. Now they're coming more commercial to help underwrite the underlying merchants. I mean, you can now, since everything's becoming digitized, if you will, you can now get demographic detail or vacancy rates, immediately surrounding that merchant when you're underwriting. You're deciding whether you're going to fund a deal from the pizza guy down the street or that auto body guy I referenced. Are there vacancy rates there? Is he going to lose business because the trends and demographics are going one way or the other? We're literally, funders are starting to use technologies such that they're becoming much more prevalent. And at the end of the day, it's good for investors because it gets default rates down. Two, as default rates come down, capital can come in, and that lowers the cost of capital to that end merchant. So that's kind of where we're seeing it on a big side. It's really on the underwriting side.
Interesting. Kenny, what's your thought here?
Yeah, I would definitely continue on that with like due diligence in general, like especially when we're looking at blockchain and ability to, have smart contracts. And I feel like this can be applied into more ways, even outside from the numbers, when we're looking at like, some things that can't be calculated when we're talking about like foot traffic that might not be, if you're gonna have someone sitting out front of the door every day to verify. Well, you don't need everyone to do that. You don't need everyone to read every contract. If we can find, a way to actually like have that on the chain where everyone understands where things are coming from, where this flow of information is. And then even outside of that, down to how we're doing marketing, personalization, understanding habits. This is really going to go down and eventually be spread to every other small business and have access to that information and be able to grow smart instead of just guess and check strategy that's been done in the past.
Got it, Nick.
Yeah, I mean, I think discussed like the implications for underwriting very well, so I'm not going to like add to that. To me, like the biggest silver lining of this pandemic for the small business asset class, and we talked about the resilience of like the subset that made it through and like the opportunity for that going forward, was the acceleration of tech adoption curves in the small business space in terms of like different products and services that, pre-pandemic, like digitization, better accounting tools, better business intelligence tools, such as some of the things that they were talking about around like in picking a location, really having the macro data to understand, potential revenues from that location for the business. All of these compounding things that if you looked 5 years ago, the percentage of adoption rate for small businesses there is just building more efficient, higher quality small businesses that are able to like get more out of every dollar that's lent to them. Drive more revenues from that. Again, expand these revenue streams to multimodal channels that previously like just weren't part of the norm. And all of that together is just going to lead to a more resilient asset class coming out of this pandemic. And the time frame to that, I think, is accelerated by the more capital that we can pump in intelligently into the businesses that need it in their communities.
Cool. So let's close out with two insights for investors themselves again. What's one thing that as an individual investor who wants to engage here, I need to learn or get comfortable with, or just like sanity check for myself before I know that I'm ready to start engaging with investments on your platform? Why don't we kick it back to Nick?
For sure. With like any kind of alternative investment, or obviously any investment in general, like any assumption of a guaranteed return should not be there, and understanding the risk. Our role as a FINRA related crowdfunding intermediary is really around investor protections and making sure that all of the information is available for investors to properly evaluate and to properly do diligence and understand that risk. Though we've seen some very, very strong performance, like really want to hedge on past performance isn't an indicator of future performance. And so in looking at how you're taking your overall investment strategy and like looking to start diversifying into some of these different alt asset classes, and I guess for the purpose of this specifically into small businesses and alt asset class, just understanding the risk and not investing more than you can afford to lose, and like really easing into it as opposed to just selling all your stocks, deploying all your capital directly into this market. We believe it's a like long-term, less volatile market, like more higher opportunity. We're seeing that in like the performance statistics to date, again, despite the pandemic. But for each investor, like having it be a part of the strategy, easing into it, like getting to understand it over time is, I think, the most important thing.
Yeah.
What do I have to know before I start plowing into franchise investing?
Well, honestly, one of the biggest things I say is go talk to your people. In the last year, we've really seen how like people's inner circles have really been a big factor in where they invest. Because it's one thing to go to a website, start learning about it from there, but it's another to like talk to the people who really affect your day-to-day life, and making talking about investing not so taboo. And people are doing it on the internet anonymously in Reddit. So I think people should be able to do that with their friends and family. So open up those conversations, be able to bounce ideas off someone else instead of making that all on you. And then, Nick really hit the nail on the head of just understanding risks and being patient, and also just not investing more than you can lose. That's definitely an important one, because people try and plow too much into something, and then, with any volatility comes, being scared. And it's something that, when you're in alternative investments, especially, you have to be able to really plan for the long term and not, hey, I'm going to need this money in the next couple months. So I'd say those couple things.
JD?
Yeah, I would harp on, a little bit of what both guys said there is risk, for the merchant cash advance space that we focus on right now at Supervest. There will be defaults. Businesses will not pay back some of these deals. I think the stats I saw recently, 1 out of 12 businesses that start up, will fail at some point. So, everyone should be well aware that there's default risk in these merchant cash advances. Now, you do get paid for that risk to a certain degree too. But, the key thing, and I think this is what Kenny and Nick were kind of getting to with their points, is the great Markowitz said, the only free lunch in finance is diversification. And, that's kind of what I like about the Supervest platform. By fractionally participating across thousands of deals, if you will, you can really diversify your exposure to any one merchant. Any standalone merchant deal may be super attractive, but you run a high risk of that, not turning out so well. So diversification is probably the biggest key risk that we talk to our investors about, and spreading that risk both over the merchant deals and over time. That's the subtlety. Over time, spread your investment out over time.
So let's close this out with one quick question. I know a lot of people are eager to get to their holiday parties and their commutes. Let's take out our crystal balls for a minute. It's the end of the year. What are we expecting from 2022? How about one prediction and one hopeful prediction? Something you think will happen and something you would like to see happen in the coming year in our alt investing space. Why don't we start with Kenny?
Well, let's see. Obviously, the one thing I hope for is that alt franchise becomes the next big thing to invest in. Got to do it. As far as other things I'm thinking about, I think that as people are getting out into the world more, a lot of things that really took off during quarantine might not continue to take off as much. So, I think a lot of the fad investments are ones that might start taking down a little bit. I mean, we started to see it with a bunch of crypto a little bit. So I think we just need to be mindful of like how the world changed in the last year or two, and how as it starts to change back, how that's going to really start affecting a lot of investments out there.
Gotcha. JD, one hope.
Yeah, I would probably echo what Kenny just said. One of the things my prediction is you see some of those fad type of investments, whether it's meme stocks or, I don't want to get in trouble saying crypto is a fad, but it's some of those things, maybe the air comes out of it a little bit, and investors look more to kind of the nuts and bolts of investing, which I think, you know, the folks here are talking about. It's a little more cash flow type of investing than maybe vapor. And one thing I hope for, like Kenny, I hope Supervest continues to grow at the pace we can. We're on an incredible track right now, so we just want to keep it going.
Great. Nick, last word to you.
Well, thank you. Last word for everybody, but I'll speak on behalf and say, I mean, I think in terms of, you know, just general like equities market pullback, I think that is, you know, like there's a lot of speculation around that, but I think it is likely to happen. There's going to be continued volatility in that, you know, we see the spikes that happen with COVID uncertainty, with the different aspects of supply chain challenges, and how that can be driven like to the point with the variability around a lot of these like the government side regulations being like on a municipal level and spiking in like different areas at different times just creates a continued sense of just like, I guess, lack of transparency, and that creates uncertainty. And whenever you have market uncertainty, you have a lot of volatility. In terms of a more positive trend, you know, getting back to a lot of, you know, the great businesses in the small business space that did successfully like weather the storm and grow through the pandemic, and are now like basically facing a supply constrained kind of market where it's kind of normalized itself. Like the big boom is gone, and you have new businesses that are going to be coming in and competing. But I think the established entrance in like the small business space, expansion is going to be a big part of 2022, and those opportunities. Businesses that have done very well and are going to be looking to go from like the 1 to 3 to 5, and then eventually 2, potentially like franchise model for restaurants. There is a lot of opportunity for kind of these incumbent players that navigated through to have a larger scale of business growth than I think would previously have been thought pre-pandemic, due to the opportunities opened in the market.
Well, let's thank everybody for participating here. All the attendees who gave us your time, panelists who really dug deep. This is a great conversation. My wish is that all of you have a happy and healthy holiday, and that 2022 is a great year for the country and all the small businesses in it. So thank you, and we'll see you next time.
Thank you.
Thanks, Eric.
Awesome. Thanks for having us.